this is a question that I get often. And what I find challenging about this question is because it's so open-ended and it actually comes with a whole bunch of baggage that you may not even realize that you have as baggage. And I use the term baggage lightly, I really do. In the sense that there's a lot of misunderstandings and historic treatments that go into this question that we have to think about very carefully. So generally when people refer to debit loan accounts, also just to clarify here, what they generally are talking about is where a company has lent money to a shareholder or a director. So in other words, a director has borrowed money from the company. Now, the reason why we have to specifically mention those is because that's not always the way we deal with it. We're also very used to having shareholders put money into the company, right? Debit loans really have a couple of consequences and these considerations. Now, this is also one of those where I'm going to suggest if this is a concern for you or if this is something you need to think about, I can't answer this question for you in detail in a session like today's Tax Cafe, simply being because there's a lot of nuance, there's a lot of different sections that go into the thinking of it. But I'm hoping that I can at least just remind you of some of the key issues and you can then go into your own reading on it. The first main point is that just because I have a company lending money to a director or a shareholder, there is nothing in the Income Tax Act that says that SARS can compel you to charge actual interest. SARS, the only time actual interest can ever be charged on a loan account or be compelled to be charged on a loan account is if there is interest payable in terms of the loan agreement. Because remember, in terms of our common law, interest is effectively compensation for use of money. And the only way interest becomes payable, and here I'm not talking about Moria interest, I'm talking about standard interest, is by agreement between the borrower and the lender. SARS is neither a borrower nor a lender, or to use the tax terminology, an issuer or a holder in the context of a debit shareholder loan. So that's one thing. Please remember, SARS cannot compel you to charge interest. They have no right. The only right SARS has is to say, okay, you chose to charge interest, here's the tax consequences. You chose not to charge interest, here's the tax consequences. So the tax consequences are not I must charge interest or I'm legally in trouble and going to be thrown in jail. It's more okay, what are my obligations to SARS by my choice to either charge interest or not charge interest? And this is also where there's been significant developments over the last few years. And it's really started in 2012 with the scrapping of STC and the introduction of dividends tax. And it's just snowballed since then, where we've moved away from this idea that tax will launch you with will throw a really, really, really big stick at you if you don't charge interest on debit loan accounts and companies. Because it used to be that under the STC rules, if you didn't charge interest on a debit loan to a shareholder, then you had to raise STC on the full value of the loan account if that loan was outstanding for more than a year. And that's where this idea that you must charge interest or else really came from. It had nothing to do with the fact that SARS was legally entitled to force you to charge interest. It's people didn't like the paying of dividends tax on the loan balance. That's gone. What we have instead is Section 64E4, which basically just talks about if I have a loan from a company to a shareholder, then we have a deemed dividend each year that that loan is in place. Now, that's another key misconception that I find coming across a lot. Actual interest is interest that is charged and is legally obliged to be charged in terms of the loan agreement. And that's something that will go through your financial records. It will show up as interest expense and interest income. It would show up on your income tax return as interest expense and interest income. The Section 64E4 deemed dividend is not actual interest. It's simply saying, you have a loan outstanding to a connected person as a company, therefore you are deemed to have declared a dividend. For the purpose of calculating what that dividend should be, we are going to approximate an interest calculation. It never shows up. The only time that deemed dividend shows up in anyone's books is in the company's books in the tax line as a dividends tax on a dividend in specie. Otherwise, there is no actual interest. Conversely, if you charge too much, it doesn't bother me. This is a very loaded question to answer simply, because of the fact that there's so many different nuances and there's been so many developments in our law. So, for example, if you do charge interest, what are your concerns? The concerns are, if you've charged interest, if it is hybrid interest in terms of Section 8F, then you may need to treat that interest as a dividend as opposed to as interest. If it's variable, you may need to use 8FA. If it's going to non-resident, you may need to consider Section 31. If it's not an appropriate market value, you may need to consider Section 7C or the attribution rules in terms of 7 or the 8th schedule. If you are not charging interest, then you may have true donations tax in certain circumstances. You may have Section 7C. You may have deemed interest income per the Brumeria principle. Better, worse? I don't know. It depends. It depends on your circumstances. That's one element. The second element is then also to think about if that debt's going to become irrecoverable. You then have to look at your ability to actually be able to claim a capital loss per the provisions of the para 56 in the 8th schedule for the holder, and also for the issuer, they would have to consider the Section 19 para 12 cap A tax considerations. This is genuinely something where I would go and say, please, there is training material available which goes through this in huge amounts of detail. This is not just a simple 5-minute question anymore. You need to make sure that you understand the different sections that now kick in where you have a debit loan account that's interest-free. So I would strongly encourage you to have a look at the tax faculty website for the varying training materials that are available for it. Alternatively, get in touch and we can put together a specialist session for you. But the main point to remember is that there is no such thing as a blanket answer. You have to consider the big picture, right? The last point I'm going to mention on that, which is not strictly speaking a tax issue, but it's one which I do think is still relevant here. Please also remember that when you have debit loans in a company, it's not just tax you have to consider. Your other legislative criteria also have to be considered in the form of financial assistance, so your Section 44 and 45s of the Companies Act, as well as the National Credit Act. And you'd have to look to see whether you don't suddenly have obligations in terms of either of those particular pieces of legislation for the debt that you've issued.